This is TreppWire Week in Review for the week ending February 2nd, 2024. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. And today we have two very special guests. Danielle DiMartino Booth, CEO and Chief Strategist of Quill Intelligence and former Federal Reserve insider, and Dan McNamara, founder and chief investment officer at Polpo Capital and mall short expert. Danielle, Dan, welcome back to the podcast.
Well, I'm excited to be here, and it's going to be pretty easy because it's Dan and Danielle. So this is good.
So this week, we've called you guys here to break down what was a very busy week. We knew that we were expecting the first Fed meeting of 2024 and new jobs data, but then we had some additional alerts in the banking sector. So today we'll use this time to explain how everything that we're tracking in the market impacts the commercial real estate finance space. So Stephen, why don't we start by breaking down how we've started the year?
Sure. Thanks, Haley. So after the Fed pivot in December, markets have really rallied here, and it seems like we are almost priced to perfection when it comes to the soft landing narrative, especially when you look at how markets were pricing rate cut expectations in late December and early January. But the Fed meeting yesterday, combined with the New York Community Bank Corp news that reignited regional banking concerns, seem to have thrown cold water on the resilience and soft landing optimists. So after we come out of dry January, are investors sobering up to the reality that there are some fundamental issues that are yet to be addressed?
I'll do ladies first. Somebody interrupt me, cut me off. I'm not going to be like an air hog. I think that the last 24 hours have been pivotal. When Jay Powell was at the podium in December, he said, and he was quoted as having said, that he'd be comfortable as long as he saw that we were getting close to the 2% target. He fully contradicted himself yesterday at the podium. He was beyond scripted. I've never seen him that scripted, and he's usually pretty scripted. The only time that he was off script was when he said no to March, and that's kind of what sent markets tumbling. And the other big takeaway was, as a former Fed insider, he surely would have been on the horn yesterday with the FDIC and talking about New York Community Bank. It's not that it's such a large institution in and of itself. It's systemically important, but it had purchased Signature's assets, and that definitely cast quite a light on it yesterday and got market investors nervous. So there was a certain irony in the Fed removing from its statement that it was certain that the banking system was sound. It was a strange time to delete that on a day like that, when you had the closest thing to a bank run that we've seen. Bigger picture in terms of Trepp's audience is the sleeping giant of rotten commercial real estate loans on bank balance sheets has been reawoken. So people are now focused once again on regional banks that have very high concentrations of commercial real estate loans and what those implications are after kind of 2023 ending with people hoping that that would just kind of go away.
Yeah, I think that's very interesting too, because we've come into January and just being CMBS and CRE specific, we've seen a tremendous rally, the biggest rally we've seen in years in CMBS spreads. CMBS AAAs are in over 20 basis points, which is a very large move. Triple B minus at the bottom of the stack, they're in over 100 basis points in a month. And these are massive moves that we don't usually see in kind of a sleepy market. And all of a sudden, I was down in Miami at a conference yesterday when 2:00 hit. And well, it started with obviously in the morning with the banking news, but obviously Jerome Powell threw some more cold water on the markets with what he said. So it's going to be fascinating coming into February and kind of we've had this tremendous rally in risk assets, which is great for this big wall of maturity we're trying to hit, we're hitting in 2024. I feel like maybe we've gotten a little over our skis here, because $7 billion of new issuance in CMBS in January, that's a nice number. But if we have, the regional banks having major issues, that's not going to do anything to knock down this wall of maturity. So even the banking news overnight in Japan, with that, the stock halted on that bank due to U.S. commercial real estate exposure. I think you're just going to see more of these headlines, right? So for me, looking back, 2023 was much more from a banking perspective, at least about an interest rate issue that all these banks had due to the rate raise in 2022. But we forgot to talk about all the commercial real estate and what a vital cog the regional banks are in commercial real estate lending. The CMBS mortgage-backed market, we're only about 15, sometimes 20% of the lending market. It's the banks that are really driving the lending market. So we really got to keep an eye on what's going on there. And that's probably even more important than, what's happening on just the CMBS side.
I think you need to look at it from a regulator's perspective and kind of what the major impediment was in 2023 in terms of brokering marriages. And, after the financial crisis, the FDIC was able to have one bank marry another bank and walk down the aisle. And they did that in a very deliberate manner, one bank at a time. And they resolved one bank at a time. The FDIC has their hands tied because banks don't want to acquire other banks' losses in hold to maturity, the losses that they're sitting on in their treasury and mortgage-backed securities holdings that are not going down quickly enough, especially given Powell's resolute stance. And in addition to that, the FDIC will have, and the OCC, they'll have an even harder time trying to broker marriages between banks because there was so little price discovery in CRE in 2023 that it's difficult to value the loan books. So this is a big quandary. And if you dove deep down inside the entrails of a lot of these bank earnings, the charge-offs that we're seeing in CRE are material.
Yes, we put out several research pieces over the last couple of weeks looking at the charge-offs, looking at loss provisions. I think it's interesting. Both of you make really valid points in the sense that heading out of 2023 in December, like the banking crisis, whatever we call 2023, when we had the three banks fail, it kind of just gone away. Like nobody was talking about that. Powell's pivot in December, kind of taking a dovish tone. Everyone was thinking 24 was just going to hit the ground running and it was going to be like off to the races again. I think the somber reality, though, yesterday resonated with people, and we're starting to see now. You couple that with some of these other data points that we brought out. So like my question for both of you is, there's been a tug of war between economists who think we're really primed for inflation to pick back up as the year progresses. We have stuff in the Red Sea, we have Middle Eastern concerns, we have other things that potentially disrupt supply chain and create additional inflationary pressure. You have others that dig through the job data and say, hey, there's way more weakness here than what the headline numbers suggest. And then there's, people kind of in the middle that say, listen, we're expecting strength in 24, resilience in the first half of the year, maybe some weakness in the second half. Danielle, I know you track this granularly daily.
Mm-hmm.
What is your sentiment around those narratives?
So it's interesting. There were two things that put me on a path to looking into the lodging sector specifically. In the last week, I just published on that today. And one of them was a Wall Street Journal article about, people taking $10 million vacations. And there has been a lot of money thrown at leisure travel. And it kind of culminated and peaked out and flamed out in basically at Christmas. So I was noticing in an inflation metric that follows 13 million real-time prices called Truflation, TRU. Several months ago, they added Hilton, Hyatt, Marriott, really huge chains. They added millions of price points from those vendors, if you will, and we saw a big pop in the headline Truflation metric. And I said, what happened? It popped over, popped well over 2+%. And the answer was, we added all these hotels, and hotel rates are so strong that it actually moved the needle on the entire Truflation headline statistic, which, by the way, they gave us the raw data. It has a correlation with headline CPI of 0.97. That is just about perfect. So this morning, I woke up to 1.44. Overnight, the thing gapped down by the largest it ever has. So I reached out to the founders this morning and I said, what's the aberration today, guys? And their response was 10 out of 12 categories. Broad-based weakness in inflation. Again, a 0.97 correlation with the headline CPI and a print today of 1.44. The message is coming home. Everybody yesterday thinks it was New York City Bank Corp and it was the Powell press conference, and they were the most important moments. For me, it was a layoff tracker that came in with a total for the month of January of 103,000 announced layoffs in January, which just about negated the 107,000 jobs created in January, according to yesterday's ADP report. And it is the magnitude and the ubiquity of layoff announcements in the current earnings season, because CEOs are completely under the gun. Challenger Grain Christmas does a very good job of tracking CEO turnover. 2023 CEO turnover wiped 2008 off the map. The average age of an incoming new CEO to replace whoever you've just henched it has declined from 62 to 56 years old last year. They want dispassionate, disconnected, young gun CEOs to come in and make their shareholders and boards of directors happy by cutting headcount. And we have seen it across the board in January. And, the people who are still saying soft landing are starting, to kind of whisper it. The soft landing camp is becoming a murmur simply because the flood of headlines is too great to ignore when you have more than 20,000 layoffs in one day a few days ago between PayPal and UPS and big names. So I think that the reality of recession is setting in. It's being reflected as it should in inflation metrics. And what I was speaking about earlier is, and I'd love Dan's thoughts on this, is we've seen office impairment 1.0. We saw that with work from home, which became work from anywhere, which became outsourcing of white collar workers, 1,000 to Mumbai in finance at a time, big companies last year. Now we have the actual recession coming in. So you have an impaired sector that's now going to meet office impairment 2.0, which is the old plain vanilla recession that would have hurt the office sector in a regular non-pandemic cycle.
Yeah, I mean, you nailed it on the head there. And I've been a big believer that, work from home is here to stay. And, I think 2023 was the year that I would say the kind of return to office probably died. Even though, Danielle, you talk about UPS and they were talking about the bringing back their white collar workers 5 days a week. I think you're going to see more headlines like that. I mean, whether you can accomplish that's fine. But overall, I think what you're getting at is, and I've always said this, and sometimes people in the last year or two have disagreed with me, is that a recession is never good for commercial real estate or office space specifically. And, we're looking for, or CEOs are looking for any ways to cut costs. And, after their employees, the number two cost is their office space. So from that perspective, you're going to see more and more of that. Yes, they're going to try to force you to come back to the office, and maybe they'll be successful, and certain companies will, and some companies won't with some of their younger workers. But overall, the square footage usage or needs is just going to be lower. Recessions are bad for commercial real estate, and recessions are bad for office. And it's this double whammy we've never seen, obviously, because we've never had this dynamic of this massive secular shift in the way we'd work, and then boom, the next year or the next 2 years, we're in this recession. It's going to be interesting. You're basically putting pressure on a sector that's down for the count. And you're starting to see these, even just away from office, a lot of the things that Danielle are talking about filtering into the retail sector. You're seeing stores close, headcount get cut. H&M just came out, which globally is one of the biggest retailers. They're cutting headcount and stores, shutting stores across globally. So I just think this is kind of a vicious cycle here, and it's not just office, it's all sorts of different sectors of CRE that are going to have unique pressure points.
Well, and we have to remember that, it's nice to talk about office conversions to multifamily, but first you need to talk about the white collar workers who are required to fill the multifamily, because 90% or whatever were luxury builds. And we're having a parallel conversation about a white collar recession. I mean, that's their tenant. That is their target tenant. And speaking to the biggest public pension funds in the country a few days ago in Carlsbad, California, there is a definite freak out factor right now going on in multifamily because the distress is piling up so fast, and they look like a bunch of deer in the headlights, as well they should. And I mean, some of them are just saying to themselves, thank God about industrial. And I just kind of walked the other direction.
It's funny you mentioned that, Danielle. I was at the NMHC conference out in San Diego earlier this week, and your comments from that previous conference you just mentioned resonated. I had several people come up to me and say, did you see what Danielle said at this? Did you see what she thinks about multifamily distress or whatever? I was like, hey, you should listen on Thursday. She's coming on our podcast, and we're going to do some deep dive on that stuff. So it was amazing seeing some folks that maybe weren't as familiar with your work, having you kind of rattle some cages there with like, hey, look, it's not all roses. It's not all peachy. So I wanted to give you guys some numbers and perspective here, and you can comment because you've hit the nail on the head with the layoffs. And I think it's interesting, like there was this misnomer, like we will go into a recession that's going to force people back in the office. But when we go into a recession, they just let people go, and there's a lot less people coming back to the office, right? Like that part of the equation wasn't factored in. So Hasbro, 20% of their workforce, Spotify, 17%, Levi's, 15%, Xerox, 15%, Duolingo, 10%, Charles Schwab 6%, Citigroup 20,000 employees, UPS 12,000, American Airlines 650. I mean, that's just in the last 90 days. And that's on top of the tech stuff that we saw in 2023. Like in 23, it was isolated to just the tech sector, but now you're starting to see it much more broadly. So just with those numbers, like just add some perspective. Like, is this, Danielle, is this like the beginning of something much bigger?
It's interesting that Dan brought up the fact that after labor being your biggest cost, it's real estate. I think what people need to realize is that white collar layoffs are expensive. So for the 12,000 that Google laid off in 2023, they announced they had a $2.1 billion severance charge. And then they said, oh, by the way, we fired another 1,000 people. You know, we don't want to make big waves and headlines about these things. But we think that our severance charges for the first quarter ended May 30, 2024 are going to be $700 million. Well, that tells me that they have an accelerating level of severance expense charge-offs, meaning they're not finished firing people. It was a Wall Street phenomenon, and that was chapter 2. Chapter 1 was a Silicon Valley phenomenon. The problem is, you just mentioned Citigroup. The problem is these things keep coming in one wave after another. Media companies are letting people go like crazy. And that's when you get to the Google actual earnings and they're like, oh yeah, ad revenues are suffering. But people put these magnificent 7 in this magnificent silo. And I'm like, if media is being hurt by ad revenues declining, then a monster like Google's also going to have, I mean, it's a discretionary expense for a company, no matter who they're paying to place ads. The waves are going to keep coming back and visiting these sectors that I think all they've done is get rid of excess fat. They haven't really started to cut yet. And that's probably not what anybody wants to hear. But all of these massive companies have huge corporate footprints in the world of CRE. Dan mentioned retail. I can't tell you how prevalent it's becoming to see Chapter 11s turn into Chapter 7s. Rite Aid announced a few days ago, we don't think we're going to be able to get a buyer. It's not going to be only a certain number of locations that are going to close. It's looking like we're going full on liquidation, closing all of our locations. I'm like, that's going to hurt retail. It's going to hurt hard. And I think that's why you're seeing the presentation that you're talking about. It was in the morning. I think they needed like vodka in their orange juice. But there were people like taking pictures of a slide that I put up that showed multifamily appraisal reductions in 2023 full year were worse than they were for office. And they're like, that has got to be a typo. And I'm like, they're unrealized. I get it. But the distress is there. And there's a greater degree of distress in multifamily than there is for office because so much has already been realized in office. But we haven't started really the realization process in other sectors of CRE.
That's pretty compelling stuff. And listen, like we've been saying for a while, the distress is there, just hasn't reared its head yet. And the headlines move faster than the distress. That's something we know, but it seems like the distress is potentially, coming to the surface. So Dan, you mentioned earlier, CMBS has been rallying. Obviously, first of the year, everyone's hungry for new issuance. But if you look at it, cap rates are still adjusting. How bearish or bullish are you on the CRE capital stack? And then after you finish, Danielle, you mentioned hotels earlier. So we want to do some deep dive into occupancy, RevPAR, some of the fundamentals that you wrote about today.
Coming into the year, traditionally CMBS does have a January effect where, you have a lot of real money investors who have money to put to work. And 9 times out of 10, our market rallies regardless of what's going on in the macroeconomic world. January has been a much stronger rally than anyone, I think, anticipated before the headlines yesterday. But it makes me cautious. It definitely does. I mean, I still think at the top of the capital stack, bonds that are very isolated from losses, there's a big desire for those assets. We're still relatively cheap to corporates. We'll seesaw back and forth, because we're a little less liquid market, but down the capital stack is what really worries me, really, because I do think that, there will be significant losses down the capital stack. And historically, if you look back 2006, 2007, 2008 vintages that were done before the GFC, you were looking at average losses between 10 and 15% on these CMBS securitizations. And clearly we've changed the underwriting a little bit and kind of, risk retention. But, my expectations because of some of these secular changes while going into a recession, I still think we're going to see in some securitizations, high single digit or low double digit losses, which would affect kind of the lowest investment grade bonds of some securitizations. So I'm very cautious down the stack. I think there's a lot of opportunity in CMBS. But I think it's not it's not a beta trade for sure. In fact, I think it's become a credit pickers market where you actually really have to understand the assets that are in these securitizations to be able to invest in them from the long side or the short side. The market hasn't been like that in a very long time. It's going to be interesting. It's going to be fun. I'm looking forward to 2024. I think there's going to be lots of opportunity, but we got to be very careful.
On the SASB side, I was thinking, at least at the end of last year, that maybe with the rally we'd gotten in spreads, the long end of the curve really selling off, that maybe there was a sweet spot, a small window where it makes sense for some of the better performing SASB deals that had experienced so much pain with the floating rate increases that they had incurred over the last 18 months to maybe go ahead and say, you know what, enough is enough. Let's refi out of this. 5-year money has gotten cheap enough. Has that window closed, do you think?
No, it hasn't closed yet. I mean, I still think that, we're looking at a 10-year note that's, 385. And I think one of the interesting dynamics, you kind of said the 5-year debt and switching it over to fixed rate, you're seeing a lot of that on the conduit side where you're actually having these 5-year, traditionally the CMBS conduit deals are 10-year deals. And you're seeing a lot of 5-year deals. And this is a new phenomenon that started last year. And we've already had a couple 5-year deals this year. We've done about $7 billion of non-agency CMBS in January. And I think that it's an interesting dynamic that you have these borrowers who are coming out and saying, I don't really want to borrow for 10 years, but I need to do something, whether they're taking floating rate debt and putting it into fixed, or they just don't want to lock in the rate for 10 years and they're moving it to 5 years. For me, I think it's kind of comical because it's actually a little bit more expensive, I think, to get the 5-year debt in general, if you're just looking at the conduit market, slightly. But again, a 385 10-year note or a 4% 5-year note, that's not that high historically. I know it feels high when you were getting 3% or 4% mortgages a few years ago, but in reality, I don't know where rates are going to be in 5 years, but I think the odds are there's a chance they could be here or higher. So we'll have to see. If they're lower, it's because we've probably had a pretty rough 5 years in the economy. Who knows? Predicting 5-10 years forward rates is nothing I want to do for a living.
Yeah, I think that was one of the most telling things was that the average maturity in multifamily has been cut in half from 10 to 5. And that was one of the biggest movers within, the subsectors that I was like, wow, okay. And hotels, by the way, they've got the highest. I mean, those are some high numbers, 7s and what have you. But before we jump into hotels, which I want to do, I did want to bring up just really quickly this work that I published about the year of refinancing for high yield corporate bonds. There is a different dynamic for corporations. If you're Joe Q, Jan Q, CFO, and your bond is maturing in March of 2025, you need to refinance that before March of 2024, because it's just a quirk of accounting. Once you pass 12 months of maturity, once you're inside that 12-month maturity window, that bond is recast as a current liability, which can quickly trash your financials. So as a corporate borrower, you want to get into the bond market and preemptively get out of the paper. Your CEO is telling you, CFO, to do it. And if you're balance sheet constrained, and we have to bring New York City Bank Corp back in, not that it's that bank, but just to say that banks in general are tightening standards still, and they're balance sheet constrained. So if they're forced to choose between a corporate borrower, let's just take a very best case scenario, Jamie Dimon, Fortune 400 company, all the executives have their accounts with the private bank at JP Morgan. They've got their line of credit with the bank. They do investment banking business with them, mergers, acquisitions, divestitures, secondary equity offerings. Or, so if Jamie Dimon's considering, do I need to be the lead underwriter on refinancing this corporate bond, or take my constrained balance sheet and apply it to a building? And it's just a different decision framework that, in theory, and especially in a recession, will cause cap rates to be higher than they otherwise would be, ceteris paribus. And so I think that dynamic is really important, because we have never hit a maturity wall in 40 years. Corporate America, corporate bonds have never, ever, 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 ever hit a maturity wall. Nobody on Wall Street can tell you what's to come, because you always had Greenspan or Bernanke or Yellen ride to the rescue and just take interest rates down in a violent fashion, such that you were able to not collide into that wall, but it is a March 2024 event. It is upon us. So I think even though you're in the CRE world, this is my greatest feedback from speaking to a CRE audience in California. Even if you're in a CRE world, you have to pay attention to what's going on the corporate side this year.
That's a scary thought, just thinking of using the Trepp data and the 2.8 trillion of CRE debt that's coming due between now and the end of 28. It's to think that that's kind of going to take a back seat, which I agree with Danielle's point. There's a lot of debt coming due, and spreads will probably have to go wider, and spreads are, at least in the corporate side of the world, priced for perfection. That could put pressure on other structured products and CMBS specifically.
Well, and that's why when I depict the maturity wall, I don't actually properly scale CRE. I purposely leave the scales identical so that you can see how much higher the refinancing wall of maturity is on the corporate side. Because I put the two graphs up on one and scare people. Anyways, one of those areas of refinancing that's about on par with retail starting in Q2 and CRE and just under what office is in terms of refinancing needs is lodging. It's going to happen. And lodging delinquencies have come down so much. They spiked and then they completely round tripped and came down. But by way of backdrop, right now, you've got a record amount of supply in the construction pipeline. Again, the theme is the same as multifamily. The majority of it is high-end luxury. You have, to the extent that Airbnb markets have not been shut down by regulators, that is a separate source of competition, and they're taking their prices down, and they're taking their prices down quickly because these Airbnb jocks, they don't have the ability to refinance. They're running out of runway. They're going to have to sell these properties. They're trying to convert them to long-term leases. So Airbnb rates are coming down fast. So there's a flip of American families moved back into hotels because Airbnb got so expensive. Now they're going to go back to Airbnb because they're going to be relatively cheaper. And having dinner last night with a hotel executive, listening to how she's advising her clients, which are the biggest hotel chains in the country, is you're in a bad way if you're in a unionized city. You've already got the issue of interest rates, and that's hard enough. But a room service delivery person making $100,000 a year, that's hard. And there's not much you can do about that. So because the employee retention credit, which I've done a lot of work on, which we don't have to get into, let's just say because in July and August, that money was exhausted, it was used then to plan holidays in the past holiday season. And what we're looking at with revenue, RevPAR, what we're looking at with occupancy is that literally in January, it hit a wall, and it hit a wall hard. So your RevPAR growth is 0.4% up Q1 to date, year over year. That compares to 1.3% Q4 of 2023 and 17% in Q1 of 2023. RevPAR growth is collapsing, and occupancy, weekend leisure traveler. And that is where the $1.3 trillion of Paycheck Protection Program and employee retention credit money that was handed out, like any other stimulus check, it powered leisure luxury lodging. So when I hear SASB, I get a nervous twitch now because there's so much lodging in that particular corner of CMBS. But this is a sector that is not being paid attention to, that does have a material amount of refinancing coming due in 2024. And you can apply everything that Dan explains happens to office in real recessions. You can apply all of that to lodging as well.
Layer on top of that, just how far we've come with technology making it costless to do virtual meetings so that the in-person, business nights really are discretionary. So on top of that, as you mentioned earlier, with the corporate cost control, once that ball keeps rolling, there's a lot more pain in store, it feels like, because business travel was one of the early things to support some of these hotels. And then the revenge travel was a fantastic sweetener. But right now, as you said, we're looking at both of those sources drying up and RevPAR collapsing.
But I mean, on a happy note, I really want to stay at the Fontainebleau in Las Vegas. It's a massive property, so I should be able to get some sweet rates there. I've got some speeches coming up in Vegas, so I'm pretty excited about this new property.
So just to give some data, Dan will know, like I don't do a podcast or a panel or a webinar without some data. Just to help back
That's
up
what I
what
like
you
doing
said.
with you.
So Danielle said a material amount of maturities. If you look at the lodging sector over the next 24 months, there's almost 61 billion worth of upcoming maturities in the CMBS universe. So that's not inconsequential. And of that 61 billion, plus or minus 20 billion of that has current debt service coverage at the NOI at less than 125x. So even in the current conditions where RevPAR ADRs are at stable high numbers, they're not making debt service through operations. And as Danielle mentioned, you start seeing a pullback in some of that leisure travel, and it gets really scary really quickly for some of these folks. So 60 plus billion next 24 months, fundamentals that are faltering. It'll be interesting to keep an eye on. And I agree with you, Danielle. This has not been something that's been discussed widely, obviously kind of underneath the office sector, but we're starting to see some erosion in the lodging sector for sure.
We haven't touched on the expense side for the hotels. I mean, those have exploded, and that's why you're seeing the low debt service coverage ratios, and the smaller operators are getting hit harder, whether it's staffing or insurance, all sorts of different expenses, kind of expense inflation. So I think that that's really been stressing people and going to continue for a while.
You know, it was just after the pandemic that when you would check into a hotel, if you were this rare person, you know, you could hear your echo in the hotel lobby, and, you know, they would explain to you everything that you were going to do for your room, all the way to cleaning your own toilet and making your own bed. And that went away largely. I've done 9 cities in 29 days, and I have been asked for the first time in a long time if I want housekeeping.
Yeah, I think the expense stuff it's undeniable. We put out a bunch of research over the last 6 months. First with multifamily, we just released our first report on the office sector. We'll be following that up with lodging. But that inflationary pressure across the expense line item stack is real. I mean, insurance is one that we don't think is being talked about enough. But if you look at multifamily office, they're actually making deals not pencil, because you're seeing triple-digit increases in the line item expense for insurance. There's no real alternative. You know, you have a very limited number of people providing insurance, and when they decide to pull out of a market or not write policies, that supply and demand curve doesn't benefit the borrower. Effectively, the price just goes up. Personnel costs significantly higher. You mentioned that, Danielle, on the union side. Just nothing you can do about that as an operator. It doesn't matter how great you operate your property, you can't reduce that expense or exposure. And then supply chain disruptions with building costs and just repairs and maintenance are significant. So we're seeing expense creep across the sectors. And to your point, any type of erosion on top line revenue. And we're seeing that with multifamily. I think the combination on multi is you're seeing a pullback in rent growth. You're seeing this increase in expenses, and the cost of capital is significantly higher than their previous financing. It's a recipe for some real distress. So I know, Stephen, you had a couple of questions. We'll transition to that. But this has been an amazing podcast so far. I appreciate both of you guys being here.
Just one more, just to pour some more salt in the wound before we move on to this next question. You know, let's not forget a lot of those hotels are also floating rate. And so if they do have extension options, you still have rate caps that you have to buy. And with SOFR still being, you know, relatively high and the rate cut path uncertain, that volatility parameter that goes into pricing these options is still going to be painful. So it's triple whammy here between RevPAR collapsing, expenses suffering inflation, and then the rate caps. It's not a good landscape. So speaking of all of this distress, if this is more or less known by the Fed, even if they're signaling something different with their very scripted narrative yesterday, the quantitative tightening, I feel like, is something that, you know, keeps bubbling up and has a good bit. So is there some potential risks for how low liquidity really is in the overnight funding market, especially given the spikes that we saw in November and December that may or may not have led to the Fed decision to make that dovish pivot? So how concerned are we about liquidity right now?
We can fall down an ugly rabbit hole, but let's just say that there has been a shock absorber for the financial system in terms of its liquidity, called a reverse repo facility. And I liken it to a shock absorber. It was $2.5 trillion. It's now south of $600 billion. They believe that this shock absorber is going to be depleted, or at least get down to a minimum balance probably here in April or May, depending on who you ask. And the reason it's been emptying out is because Janet Yellen's been selling treasury bills, money market funds, just flip out of this Fed facility into the treasury bills, because the Fed has finished raising interest rates. But what it means, and the reason I'm using the analogy of a shock absorber, is that if you have a huge $2.5 trillion shock absorber, you can hit a pretty big pothole. and you're not going to do any damage to the car. Once that shock absorber is absorbed, you might be breaking the axle. And the reason this plays into quantitative tightening is because we haven't felt it. Other deposits liabilities is something I follow weekly in the Fed's H8 report. They're down by $2 trillion. And you're like, well, you could have fooled me. But that's a big, big amount. It's about a 1.5 multiplier effect for every $1 billion of quantitative tightening. But we haven't felt it because this shock absorber has absorbed the shock of all of this liquidity coming out of the system. When I say a bank is balance sheet constrained, I mean, if they're bleeding deposits, if commercial and industrial lending is turned negative, crazy things are occurring that you only see in recession, by the way, in the banking system. But when you have this huge shock absorber and a very politicized Janet Yellen trying to sell as many bills as she possibly can to keep, the reality of how bad the government's finances are, you don't see how bad the liquidity is in the financial system until it slaps you in the face, until you break the axle. And so that is its own separate dynamic. Forget about what we were talking about with losses that banks are sitting on, with unknown losses that they're sitting on in their commercial real estate portfolios. Forget about those two. There's a third aspect called liquidity. And it is critical in the coming years because the more balance sheet constrained banks are, the more deliberate and choosy they're going to be in what kind of lending that they're willing to make.
So I feel like almost ostrich-like, and I want to think, where do I put capital to work? Do I go play some defense for a few months? How do I wrap my mind around when to start playing offense and what type to play?
I mean, there's definitely places to play offense, but I think overall, in fixed income and in the CMBS specifically, like it's higher quality assets. I mean, there's still plenty of higher quality, things in the CMBS market you can buy that you can kind of get mid high single digit, depending on your return profile and your risk profile. But you got to be very careful. Like I was saying earlier, there are plenty of bonds out there that are going to zero. So you got to be very thoughtful about risk. And this right now, I mean, post this rally too. I mean, we've had January has been a great rally, but we also rallied in November and December. And, yields and spreads on bonds are much tighter than they were just 3 months ago. So you just got to be careful. And I think you're supposed to probably be a little patient here. I don't think that this Goldilocks environment or this soft landing that kind of makes me laugh a little bit, because I don't think it's a reality, is here. But that doesn't mean that there's not opportunity on the long side. And, I think today there's probably more opportunity on the short side.
If I can interrupt, I have a question. I have a burning question for Lonnie and all of his data. You're in Dallas, Texas. I'll eventually get back to Dallas, Texas. I've been gone since January the 4th, but I'll eventually get home and get back to Dallas. Why doesn't anybody talk about, I hear about vacancy rates in San Francisco and Los Angeles and New York in office. If I want it for QI research to get office space, all I have to do is change my business bank account from Chase to Comerica, and they'll give me office space for free in their tower in downtown Dallas. Why doesn't anybody ever talk about these insane vacancy rates and how much construction has gone on in these major Texas markets in office?
Yeah, I think it's a good question. I mean, and what's really interesting is if you look back 10, 15 years for stabilized occupancy across the major markets in Texas in the office sector, stabilized occupancy is about 80%. So there's a normal vacancy factor of 20%, which is just mind-boggling. If you look at multifamily, it's, stabilized occupancy in good markets should be somewhere between 90, 95%. Hotels even sometimes have higher occupancy than some of these office markets. And it's really interesting. I saw some stuff maybe 4 months ago that looked at the large downtown Dallas office towers and what their cost of construction was 20 years ago, 30 years ago. And then every subsequent trade since then, there's really no material value appreciation on those buildings because the stabilized vacancy rate is too high. And now you double that up to where some of these markets have 40% vacancy. And it's really hard to even quantify like what the sublease availability does and what the shadow vacancy is in these markets. I mean, I think that's the part that, I don't have the statistics in front of me for Dallas. We look at like Minneapolis as an example, 3.5, 4 million square feet of sublease availability on top of their true vacancy. I'm not good at math, but if you just take the typical lease size of maybe, 40,000, 50,000 square feet, and you divide that into the 4 million square foot of sublease space, just by just mathematical terms, this isn't a 4 or 5 year turnaround. You're talking like a 10+ year turnaround. And that's assuming some sort of natural absorption that's above historical norms. So people don't want to talk about that because every time you drive through a city, you see downtown office buildings. And if people actually allowed themselves to feel the impact of what that means, like if the office sector truly does get depleted from a value perspective, 40, 50, 60% at scale, I mean, that has significant economic impact much more broadly than just that local CBD or whatever. And so it's really interesting. Stephen put out some research a few months ago. For the first time in history that we've tracked the data, urban office had higher delinquency than suburban office. And so we've seen this paradigm shift not only in just worker preference, but now it's starting to show up in the data in terms of delinquency, that urban high-end Class A offices actually had a higher percentage of delinquency than suburban. And we ran a simple analysis that said, if you look at in-place debt yield on current maturing debt, fourth quarter 23 through end of 24, plus or minus about $30 billion worth of maturing loans, in-place debt yield on those loans were 8.8%. All 2023 issuance in office, underwritten debt yield was 15. So if you assume you maybe have a strong sponsor, you have some of those relationships you were talking about, Danielle, at a bank, you could get a 12 debt yield on underwriting on a refi. There's a deficit of about $9 billion in total. You're getting about 73% of proceed payoffs. You're going to have to cash in about $9 billion. So the narrative, like the headlines are pervasive, but I don't know that people are digging a little bit deeper, because when you start looking at that broadly, it could be very systemic very quickly. And even in markets like Texas, where we're having net in-migration and the underlying fundamentals support growth, there's a scary story to tell there if you dig a few layers below the headlines.
I have a solution for Dallas, though.
Let's hear it.
Do you want to know what my solution is?
I'm ready.
Okay. So I think Clyde Warren Park is beautiful. So what I think we should do is we should extend it on the side of the opposite of Victory. We should just take that whole side of downtown Dallas and just make it green and plant some trees. We can expand the Nasher Sculpture Museum. There'll be a lot of room for that. And that way, everybody who wants to office in Victory can office in Victory, and you'll get rid of your occupancy headache overnight, and it'll be beautiful.
Yeah, isn't that like, just change the denominator and you get a little bit different outcome? I mean, I think that's I
mean, don't tell Ray Hunt. It wasn't that long ago that he built the building on the wrong side of Victory, but wrong side of the highway. But that's my solution, is we just go green.
Yeah, I'll let you pitch that.
Austin would be so envious.
Oh, Austin, yeah. I spent 6 years in Austin, so I understand what the challenges are there. They would be envious for sure. They have a green building code in Austin, first of its kind in Texas. Listen, like Dallas is a weird conundrum in the sense that like Goldman Sachs is opening up another huge office tower. They have construction right now. Supposed to be bringing thousands of employees here, but you look at State Farm, they just sold their corporate headquarters out in Richardson. I think it was like 285 million, maybe 385 million. That was $1 billion type of facility just 5 or 6 years ago. So it's just weird how the market plays itself out, right? I think it kind of goes to Stephen's question of, if you have capital, where are you investing? For some people, maybe they see opportunity that I just don't see. And for others, if you just look at the data, like I don't know why you would be putting capital to play here when historical stabilized occupancy in the office space is 20, vacancy is 20%, stabilized occupancy is 80. Like, just not a good track record in terms of that scenario.
So the managers in the audience did not like me in California at all. Yeah, they did not like me at all. Actually, I'll tell you a funny story real quick. I was in the bar watching the New Hampshire primaries on the big TV and writing my daily. And this guy walks up to this younger guy I'd been talking to about, your presentation and blah, blah, blah. And he said, "Oh, there comes my boss." And I'm like, casually dressed like I am right now, black top, blue jeans, not my bright red dress that I was wearing on stage, looking like the devil apparently to him. But he walks up and he's like, "Yeah, I just got off a conference call with my board of directors. And I was telling him about this crazy woman in the morning, this Dr. Doom and Gloom and everything she was. Did you happen to see her?" And I went, "It's just data." And he turned white and he was very embarrassed. And his young lackey didn't quite know how to react to the boss, but maybe he had to be there. But Dr. Doom and Gloom, I was like, man, that's just awful.
Before we close, I think, Dan and Danielle, this has been an awesome episode, but why don't you leave our audience with one final thought And maybe we'll make it a silver lining for 2024. So Dan, why don't you kick us off?
Yeah, we'll try to make it a silver lining. It's not as easy with Danielle and myself sometimes, but when we go down these rabbit holes. But no, I do think that, there's a significant amount of opportunity on the debt side of the CRE market. All the things we're talking about, whether it be impairments on certain sides, but or just in reality, we're going to need new capital and new structures, and that will provide lots of opportunities for people with fresh capital. There's not a lot of solutions for people that are in impaired assets today. We're going to need new money, and we're going to need new structures to kind of help us out of this mess. We'll get through it. I mean, I don't believe this is systemic. I think there will be pockets of severe pain, and I think there'll be large pockets of opportunity. So, I'm optimistic that, the CMBS market will rebound. We rebounded from 2008. We'll get through this. Overall, it may take a lot of modifications and extensions and some short-term pain, but I mean, overall, I think that, the CMBS as a whole, the pie will probably grow bigger as the regional banks will pull back. I mean, that's just a fact. I think that's a kind of a green shoot, is that the CMBS market, on the other side of this, could get larger and bigger and more influential.
I did hear, this might not be a silver lining, but it was certainly a mature way of looking at what's to come. I made this comment in California because on that day, $1 billion had been raised to buy distressed office properties. And, I made the comment, being the happy person that I am, that I'd rather wait for the next distressed fund that was set up to buy the properties from them. So I'm like, wait for 2.0. And this person was a Californian and telling me that the 15-year-old mall on Union Square that had Nordstrom's flagship store that's no longer there, they were going to raise a 15-year-old property off the ground because they recognized how severe and how long the impairment might last, but that there was really good quality land sitting underneath it. And, in Dallas, we've got North Park Mall, we've got Valley View Mall. Somebody finally said there's only so many Halloween shops you can set up in these. Data centers need space, and AI is big, and there's something to be said for that. But B, I think office developers should appreciate the lessons that have been learned in retail, and that's that sometimes you should cut to the chase if there's no economics in trying to restore a building or get it up to snuff or get the financing or pour more equity into it. I think that everybody should be looking at CRE in terms of the land underneath it and how valuable that property is in terms of its location, because that's still something that is of inherent value, is where something is.
That's a great point. And also to your other point, I mean, RXR, who 6 months ago was, kind of started the ball rolling, or at least said something that a lot of people probably didn't want to hear from commercial real estate office owners, is that they may give the keys back on a, I think at the time he said 10 or 15% of their portfolio. And this is the same company that's partnering with Ares and raising $1 billion office fund. The side of it is David Rubenstein at Carlyle. They raised a multi-billion-dollar fund to invest in multifam and industrial properties 2 years ago because it was an amazing opportunity. Well, it turned out that was probably the top of the market. They're out now they just raised are raising a $400 million fund, and now they're saying that this is the most amazing time to invest in multifam and industrial. So you could be right, Danielle. Maybe it's better to wait for the second fund. Who knows? Timing that stuff is very difficult, but I think you nailed it on the head with, you start with what is the actual ground underneath the building, and we'll go from there.
Yep.
Well, thank you, Dan and Danielle, for joining us today. We're so glad to have you back on the TreppWire podcast as repeat guests, and we'll definitely be in touch and talk to you more in the future. But listeners, make sure you look up Danielle and Dan both on the Twitter space, or we'll call it X, but it's really Twitter. And if you want to learn more about them, just give them a Google. You'll see them cited all throughout the news and what they're looking at, what they're researching, and where they're at.
Thanks very much. Take care.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com. For more info, visit trepp.com and subscribe to the TreppWire podcast with your favorite provider. Thank you for listening, and stay well.
All right.
Welcome.